Hello there, everybody, and welcome to Beyond Markets, Julius Baer's global webcast looking at the most important investment topics facing you as investors. In our final edition of 2023, we're looking at the big trends impacting markets in the next 10 years. So really digging into the topics that will inform and influence our investment decisions in the long term. Now, at Julius Baer, we call this our secular outlook. And joining me is the author of this outlook and our Group Chief Investment Officer, Yves Bonzon. It's great to have you here with us here, Yves. And of course, as always, we have a very open forum, so please do feel free to put your questions to Yves. Just click on the question mark button on the right-hand side of the screen. You'll also see there is a polling icon at the bottom right-hand side. And we have a question for you. In fact, we're asking you today what you think the main topics will be that will influence our investments in the coming decade. You can click on that icon, answer the question, and we'll bring you some of your answers a little bit later. But first, let's get into what we think the next 10 years holds, Yves. And just as a bit of a background, this is really, really crucial to our strategic asset allocation as a bank, but it's also what sets our investment approach and our process apart from maybe other banks. Why is it so important?
It's of the utmost importance because the primary driver of a portfolio returns over time is the strategic asset allocation and the assets you pick and choose to assemble that portfolio. In making those choices and assembling assets together, it's absolutely crucial to understand the structural forces at work in the system. So for instance, until late last decade and the start of the pandemic, we had more than 3 decades of relentless disinflation turning at some point borderline deflation conditions. Last decade, the central banks were essentially busy fighting the risk of deflation. That has changed, as we know, since then. But 30 years is a long time. If you swim against the tide, not understanding these structural forces, you'll be in trouble, and it will be very detrimental to your portfolio returns over time.
Okay, so over the last decade, this outlook for the following decade must have changed quite considerably given the kind of underlying factors that are affecting our central banks. And really, there hasn't been a year quite like 2023 or 2022 in the last couple of years. So how does that affect your decisions for the next 10 years?
Yeah. Look, the assumption pretty reliable you can work on is that every decade will display different trends, different key events, such as, for instance, the introduction of the euro in 1999. This is a major market development. If you want to talk about something even more important, 1971, when currency started to float. These are major regime breaks in capital markets. And early on in a decade, you have very low visibility on what will be the defining trends and associated asset class leadership in the decade that is starting. But it's a pretty strong, in terms of probabilities, working assumption that what worked the previous decade is unlikely to work the next decade.
So let's look then at the secular outlook 2024, which is for the next decade until 2034. It's been dubbed the Great Normalisation. So I'm assuming, given what has happened in the last year, are you expecting this normalisation of interest rates and inflation to have a big impact?
Clearly, the investment regime has changed away from deflation. That was the main risk last decade. And we carved out an important aspect back in 2019 when we first published the secular outlook for the decade 2020, when we said neoliberalism has ended. Neoliberalism was founded on monetarism and the thesis of Milton Friedman. These ideas that you need to run public finances in a very conservative way, most extreme version of which is the Schwarze Null policy in Germany, which does not allow for recurring government deficits. And you manage the economy primarily through the use of monetary policy. After 3 decades of fast financialization and asset price inflation, combined with stagnation of inflation-adjusted wages for most workers in the developed world, we said the political forces are shifting away from neoliberalism and more state intervention in the economy, a greater share of GDP that is steered by industrial policies, state presence, etc. Why? Because the median voter in Western democracies wants a more fair distribution of wealth creation in the system.
And we've seen so much of this since COVID.
Of course. COVID in this respect was a formidable accelerator because, you know, governments don't change course in a fast and agile manner. Decision-making processes are slow. There's a whole institutional framework around it. And of course, there's no better opportunity and better excuse to change course than an external shock of the kind COVID was. And essentially, fiscal orthodoxy was sent to the dustbin overnight because there was a perfectly legitimate reason to make extensive use of fiscal policy given the circumstances.
And so this will continue then for the next decade. Is this the new normal then, having this fiscal policy, this industrial policy, where governments prop up the industries that best serve our economies?
To various degrees, absolutely. We have seen that with the so-called Inflation Reduction Act in the US. This is actually a broad-based industrial policy plan that is actually underpinned by US foreign policy. So it's very tightly intertwined.
Mm-hmm. And this, the Inflation Reduction Act, is also another example of another trend that you see for the next decade, which is reshoring.
Yes, there will be some degree of reshoring.
Because that's part of it, right?
Oh, absolutely. But we believe reshoring will be very targeted and very strategic. We're reshoring some critical goods, production capabilities, because the Western world wants to, rightly so, prioritize safety of supply over price of supply. And this will have a cost. You know that, for instance, the leading manufacturing chip company, Taiwan Semiconductor, is building a factory in America. It's probably not very efficient to locate that factory here, but it makes sense from a geostrategic point of view.
From the safety side of things.
Are we going to reshore goods that are not strategic, like the production of T-shirts? Extremely unlikely.
Okay, but how then does reshoring in general terms, how does that impact investors? How should they take stock of this?
Well, I think it has indirect impacts through, for instance, additional demand for labor in the economies where you reshore. It also means that some resources in the system will be allocated to these activities rather than other economic activities where the country has a better competitive advantage. And that is, by design and definition, suboptimal. You know? So we are willing to sacrifice some growth potential. We are willing to pay some additional cost for the benefit of the safety of supply, essentially.
Okay, but when we start to see this kind of reshoring, it begs the question, are we going to see a full decoupling between the US and China? Because I think, and I haven't brought the results yet of what, you know, our audience believe might be some of the big trends that will affect this, but I'm assuming this geopolitical tensions will be one of them, and the difference between the US and China and the potential for decoupling.
No, absolutely, but fundamentally we believe China needs the US and the US needs China. So there, and you know, a lot of the, typically in the US, but as well in China, a lot of the foreign policy rhetoric is actually addressed to a local audience. You know, it's a political posturing. There's a very critical domestic agenda behind those posture. But at the end of the day, there is the reality of the economy. There is the reality that no one wants, especially in the context of geopolitical confrontation, no one wants its economy to go through a deep downturn, recession, with unemployment. And therefore, ultimately, rationality will prevail, and you're going to see a continuation of substantial trade flows between not only China and the US, but globally. You see some activity, you see some reshoring. You know? And realpolitik is such that, for instance, Chinese companies are building manufacturing capacity at the US border in Mexico, you know. And the goods eventually will be imported from Mexico rather than China, but produced by Chinese companies. So at the end of the day, we are reasonably confident that pragmatism prevails.
Okay, let's bring you the results then. We asked you in our poll, and you can still take part in the poll, by the way. Just click on the little poll icon on the platform. It's at the bottom right-hand side. And you can tell us what you think some of the main trends will be over the next decade that will impact your investments. Let's bring you the results so far. And Yves, I'm not surprised, as I predicted or as I assumed, people would say geopolitics up there, but artificial intelligence right up there as well. Are you surprised by any of this? AI, artificial intelligence, protectionism, pressure on the dollar? I see more and more people adding now, but I think the leaders remain geopolitics and artificial intelligence. Yeah. Let's go with geopolitics first then. I mean, there's lots to focus on here. And I mean, there's, you know, so many things that are going on, lots to distract investors, especially in the short term. You've got the Middle East, you've got the Ukraine situation, Taiwan, even developments in Venezuela. Maybe you can put geopolitics into context.
Look,
if at all
we of course follow, with the help of external experts, development on the geopolitical front. But the first point that is important on the topic, we believe it has ultimately limited influence on the way and how we manage portfolio day to day. And we've seen that again with the tragic events and the start of this war between Israel and the Hamas in Gaza. As tragic and sad as this situation is, I think everybody agrees on this. Concretely, it doesn't constitute a market-relevant development. And this is the call we made back in October. Rightly so. At the time, everybody looked at us in disbelief. The positioning and the sentiment in the market was very bearish in October. Everybody was bullish oil, betting on an extension of the conflict and tension on the oil price. We were bearish oil, bullish bonds and equities. And as November demonstrated, this was the right stance. So we should not let ourselves be distracted by politics, by headlines in the media, which, by the way, are very biased in the way and how they portray news. This is very detrimental to a sound and healthy investment decision. And
I mean, this is the key point, is that investors often get distracted by these short-term headlines. And this is the value of a secular outlook on longer term.
You know, if you study the history of the 20th century, many major political and geopolitical events and development happen. Ultimately, markets continue to develop and provide investor with compelling returns over time. There's one caveat here I would emphasize and mention. What happened with the start in the war in Ukraine in February of last year has had structural consequences. And that's typically a secular outlook topic, because as a result of the start of this conflict, Western governments upgraded to a completely different level the weaponization of capital markets for sanctioned purpose. So this means, since the fall of the Berlin Wall and the rise of emerging market as an asset class, the investment playground for all of us was global. If you think the best opportunities are in China, you look into the Chinese markets, invest some capital there. If you think it's South Africa, and so on. This ended with the sanctions after this conflict started, because obviously investors suffered losses, in particular on Russian bonds and equities, not because the economic merits of those investments were not compelling, but because of political decision. And this is something that is, of course, hard, borderline impossible to predict, beyond your control. So you need to adapt. And this means, and that's one of the reasons why, by the way, investors are so bullish. The consensus is very bullish at the moment on Japan. Combination of Japan has know-how in some critical industries and benefits from reshoring. The BOJ will have eventually to as well exit financial repression, which will be bullish for financial assets. And Mrs. Watanabe will invest more in the Japanese stock market. Japanese households have a very, very low equity quota in their overall balance sheet mix. And finally, and critically, outside of the US, what are the alternatives today for a Western investor? What are the alternatives? You can invest in China. There are compelling opportunities. But you know that there is a geopolitical risk in investing there. And that's a direct consequence of the weaponization of capital markets by Western governments.
Okay, let's dig into some of the investment ideas based on the secular outlook in just a moment. But I want to cover something else that came up from our audience, and artificial intelligence, AI. This is going to be one of the things that really impacts investments going forward. Our audience said it. I know you will agree. You've called it this so-called innovation supercycle because, we always have an innovation at some level, but really AI is going to ramp things right up.
Obviously, the developments of AI have accelerated. We are at the very beginning of an S-curve of deployment of AI solution in the entire economy. The consequences are so broad. One should prepare for every possibility, one of which is disruption of some established business model, potentially productivity gain of the exact same nature as the productivity gains you observe with the rise of the personal computer, Microsoft Suite, the ability to use in a user-friendly way spreadsheets and word treatment software, etc. That's the exact same idea, but yet to another level. At the beginning of the decade, one area we were looking at extremely intensively is the rise of data and artificial intelligence in healthcare, both for drug discovery, diagnostic purpose, etc., because this is potentially a huge revolution. And like many businesses, healthcare is increasingly becoming a data-driven business. So I think that the revolution is much broader than this. This theme remains a valid one. As usual, in a technology revolution, you have those providing the picks and shovels, and there's a well-known by now a semiconductor company that is at the forefront of that supply of picks and shovel trend. But you have also many other businesses that eventually will develop. Maybe also in some instances, the cost structure of some businesses will change. The capital intensity of the businesses will change. So this has extremely broad-based implications.
What I find really interesting is that you talk about healthcare as being probably one of the areas in AI that's going to see a big impact. But this is on a long-term trajectory, but even on a short-term trajectory, when we look at our market outlook on the shorter term, this is also very relevant. So this healthcare topic, goes right across across both kind of long-term and short-term. What about the energy and transition? How far along have we come already, and how do you see that developing?
Look, green energy has been a very big disappointment for investors this year across the entire spectrum of sub-industries, including solar, etc. Our interpretation is as follows. Probably the energy transition is not only well engaged, but potentially more advanced than generally perceived and discounted. And as a sign of anecdotal evidence of this, you observe price deflation. That's why these sectors have performed so poorly this year. You see price deflation pressure in many of those energy transition related sub-industries. So a lot of supply, compared to demand, that is pressuring the price of these solutions and therefore pressuring the valuation of the companies that provide these solutions. Is it cyclical? Is it structural? We would lean on the structural side of the equation, but we talk about potentially here healthy price deflation, price deflation that is driven by technological innovation and more efficiency, more productivity. So that's good for the economy, that potentially free up resources for other economic project and sector. Our take on this, the green transition is progressing probably at a faster pace and is more advanced than we would have believed 12 or 24 months ago.
What do you think of the outcome then from the COP summit just yesterday? Finally, they're starting to talk about fossil fuels. That's right in there in this agreement. Do you think we'll ever be free of fossil fuels? And I suppose this is probably a question that's even further than the secular outlook. This is longer than 10 years, right?
No, obviously it's a very long-term, distant outcome. What we can say with reasonable confidence is that our fossil fuel intensity has peaked. And from there, it will be in a slow, gradual decline. Fossil fuel, if you exclude the externalities, is an extremely efficient, cost-wise source of energy. And the world, again, pragmatism prevailing, the world will decarbonize in a gradual and orderly manner. So I think the direction of the travel is clear. Betting on an acceleration in a complete phasing out of fossil fuel in the next couple of decades, I think is pretty bold. But probably we're seeing early signs of peak oil and related fossil fuel demand.
It's very interesting, certainly. I just want to remind everyone, you can ask Yves a question on the secular outlook, which is some of the looking at the trends over the next decade, just by clicking on the question mark button. I can see quite a few questions coming in. A lot of them are on the kind of shorter to medium term questions, so maybe we'll kind of address them also in the longer term. Okay, let me bring one of them, because is the SMI poised to recover in 2024 after a disappointing 2023 compared to other major equity markets? So this is
Swiss equities.
Yes, this is Swiss equities, but I think, safe haven equity markets are mentioned specifically in your secular outlook, and obviously here in Switzerland, the SMI is interesting. But
so I think it's a very important topic. Thanks for the question. The one big trend that a lot of investors got wrong is the relative performance of US equities versus other equity markets, versus the rest of the world. If you look at the relative performance of US equities, going back to the 1960s, you see a very clear pattern of mean reversion. So you have an alternance of decades, multi-years trend of outperformance that eventually roll over and go into reverse, and periods during which non-US equities, in turn, outperform US equities. Starting beginning of last decade, after the great financial crisis, mean reversion in favor of US equities started, And it actually carried on with an absolutely stunning breakout in the last few years. So if you take a long-term chart of US versus the rest of the world, you have that mean reversion pattern, and we have completely gone off the chart in favor of US equities. Most investors have, wrongly so, bet on the mean reversion of this. So first point, what drives this? It's important to have a very clear view on the driver of this. No, it's not a remake of the dot-com bubble. Absolutely not. This outperformance of US market is driven, as we know, by some major leading companies. And the performance of these businesses and the associated stock market performance of their company stock is underpinned by unprecedented free cash flow production of these businesses in a context of dramatically reduced capital intensity. Okay? So this is free cash flow driven. And unless the free cash flow yield compresses to the point that they become excessively expensive, which they aren't still today as we speak, this is unlikely to go into reverse unless you believe the earnings, or more precisely the free cash flow, because this is what matters. The free cash flow is itself the product of a bubble. Now, let's look at what happened this year. We have one of the fastest and strongest monetary tightening ever. The dot-com bubble took place in the context of a massive monetary easing after the Asian crisis started in '98. The world financial system was flooded with liquidity at the time. This is what created this peak in valuation in 2000, not just for dot-com stocks, by the way. All quality businesses, the Walmart, the L'Oreal, etc., were equally very, very expensive, trading in the 40, 50 times earnings at the time. This time, the multiples are perfectly fine. This is driven by the free cash flow production. This is, by the way, the combined impact in 22 of interest rates and a temporary pressure on free cash flow production in these leading companies that has led to the underperformance in 22. In 23, they have spectacularly recovered all the way back to their performance relative highs because free cash flow production has recovered. This free cash flow production is unique to America. So when you look at these free cash flow metrics, in particular the free cash flow margin, which is the free cash flow as a percentage of these companies' revenues, it's unmatched anywhere else in the world. No one even come close. There are some businesses with equally strong economic fundamentals outside of the US, but they are far more rare and few compared to the US. So,
and this is going to stay in the US? This is going to continue?
So this is going to stay. Now, they were underpriced at the beginning of the year. It's one more thing that has actually normalized in 23. They are back to normalized valuation. They are not overvalued. They are back to normal valuation with reasonable expected returns based on their economics from the current starting point. And actually, I'm coming to Swiss equities because that was the question. If you look at Swiss equities, the three best performing stock market long terms are US, Switzerland, and Sweden. If you look at 20, 30 plus total return for these asset classes. Actually, interestingly, very close to that, competing with the US as well, is India. Interestingly, the Indian market has very, very good long-term return. Parenthesis closed. If you look at US equities, like the S&P 500, not on a capitalization weighted basis, where, for instance, the so-called fabulous 7 stocks account for probably around 30% of the market cap today. But you look at the S&P 500 on an equally weighted basis, where every stock is 1/500th of the index composition. Actually, you compare this with Swiss equities, you have the exact same line. We wrote a weekly recently on the topic, the chart is included. It's the same payoff. Why? Because they have the same economics. One of the problems of Switzerland is idiosyncratic risk, because you have a high concentration in three leading companies, and if any of those companies run into some sort of problem, litigation or whatever can happen to a corporation, this might have stock market performance-wide implications, in terms of how the asset class performs, given the disproportionate share these companies account for in the Swiss asset class. In other words, it's a market of stocks as much as it's a stock market, Switzerland. But yes, they will perform. Yes, we are positive on Swiss equities. If you want better idiosyncratic diversification, then you need to turn your attention as an alternative to the S&P 500 equally weighted, where there, by definition, idiosyncratic risk is super diversified because no company accounts for more than 1/500 of the portfolio.
Okay, and outside China, you're looking at India.
Well, we're going into tactics here.
Okay. Well, okay.
No, I mean, fundamentally, China is in a situation of balance sheet recession. And by now, I think most experts and observers agree on this. China has the means and potential policy solution to manage that period, extract itself in an orderly manner from the deflation risk that is associated with balance sheet recession. There are losses in private sector balance sheet in China, corporation and household, that are not marked to market, unrealized, and the realization of those losses is potentially highly deflationary. And you've seen Chinese CPI actually turning recently negative. So the point is, similar to Japan, starting in the mid-90s, the private sector of China is in high savings mode, and absent fiscal stimulus and the acceptance by the Chinese governments of recurring deficits, the way Japan accepted deficits since the mid-90s, China is unlikely to heal and exit its current balance sheet recession situation. In isolation, this is actually disinflationary for the rest of the world. Lower value of the renminbi, lower price of exported Chinese goods in a context of targeted reshoring, not broad-based reshoring. So this has actually counterintuitively positive market implication for the rest of the world.
Okay, I'm going to stop it right there because we have lots and lots of questions coming in from our audience, because you've obviously piqued their interest, because a great point about the free cash flow situation, US stock dominance, but does this rise of passive and thematic investment cause you concern, i.e. is the day of chasing alpha over?
Alpha, the holy grail. Look, we have strong performance in our equity solution. We have a great team, strong equity franchise. Over 3-5 years, we ranked at the very top of the peer group in our global large cap strategies. One of the reasons for this is because when I review with the team their portfolio on a quarterly basis, I sit down with them and I go through the entire portfolio, every bet that is in action in those strategies. And I challenge them in a constructive manner, sometimes far more on what they don't own than what they own. And there is a reason for that. If you take the S&P 500, over a 10-year rolling period, 10% of active manager, on average, beat the index. So if you pick randomly a US equity large cap fund, you have 10% probability of beating the market. The problem is compounded by the fact that the next rolling 10-year period will also see 10% of the manager outperforming, but not the same as the previous one. And eventually, the third rolling decade, those who outperformed previously will be due for retirement, and there will be a change of manager, different skill sets. Charlie Munger who was a legend and will be dearly missed. And of course, Warren Buffett are really the exception given their longevity. But even the all-time greats like Peter Lynch hardly lasted as long as the legendary managers of Berkshire. But the point I'm getting at is outperforming market is difficult. Now, you need to understand where does this market performance comes from. And recently, initiative of Baillie Gifford, the Scottish asset manager, well known for its equity expertise, have mandated a team of academics to study the source of US equity return. So in a nutshell, cash produces, let's say, 5% long term. Equity is 10%. You are compensated an oversized additional return of 5%. I say oversized because if you study the topic, in theory, you're way overly compensated for equity risk. I think the reason for this relates to investor behavior because as equities are the most formidably risky asset class short term and the safest asset class long term, the problem is risk aversion to short-term losses and the risk of experiencing one of these very nasty 1987, spring of 2020-like stock market drawdown. And as a compensation for that risk of being hit by a truck in the short term, investor demand over time a oversized risk premium. How is this, let's say, roughly 4 or 5% extra return produced? And the finding of that study by a group of academics, the so-called Besson-Binder study, found out, and they've studied different time windows, the conclusions are similar. For instance, if you take the period 1990 to 2020, and you look at all the stocks that have been listed on America's stock exchange during the period, you find out that 100% of that excess return, from 5 to 10, has been contributed for by 2.4% of listed companies. Meaning the other 97.6% in aggregate have produced stable return at equity risk.
Okay.
What conclusion do you draw from this? You cannot afford to miss the big winners. And stock market is not democratic. It's a very elitist mechanism of allocating capital. If you are underexposed to the big winner in the stock market, you have no chance of coping up with the index performance long term. And that's why indexing works. The index is never underweight the winners.
So there is, a role for chasing alpha, but it's these long-term trends that will see you through this.
Yeah.
If I can summarize.
If I may reset everyone's expectation on this call. Your primary objective is not to capture alpha, because we all know alpha is a zero-sum game pre-cost and a negative-sum game post-cost. Meaning for every dollar of excess return that someone capture, you must find somebody who is willing to underperform by that same $1, okay? So your first and primary objective is not to be the patsy at the table. In other words, not to be the guy who provides others with that dollar of alpha. In other words, what we are trying to help with, our value proposition, is first and foremost to avoid mistake, avoid avoidable losses, and not leaving money on the table for a given level of risk that is appropriate to your circumstances. So you want the risk that you take to be fairly compensated over time. And you want to prevent negative alpha because this is going to be someone else's positive alpha. You don't want to be the guy who sponsors other investors, in other words.
I love this description. I'm going to clip this up and put it on social media. Everyone needs to hear this. I want to get to as many questions as we can in the next 5 minutes. So does the dynamics of the European market follow the USA and therefore, as usual, lag behind? Or could we finally expect an uncorrelated better reward, at least in the medium term?
No, I mean, we've seen on yesterday's, sorry, this is secular outlook, I'm getting into tactics, but I know you care also about the short term. We've heard Chairman Powell yesterday, clearly an inflection point at the Fed. In the equity space, the main victim of the tightening campaign of the last 2 years have been US small caps, and companies with leveraged balance sheet, short-term funded liabilities, etc. We've seen a strong rally in the Russell 2000 in response to this. The Russell 2000 is a junk universe. Nowadays, 30% of companies in that universe are loss-making. 15 years ago was only 15%. And we see those assets leading the rally on the decision of the Fed, rightly so. And what does that mean? Market breadth will broaden, And I mentioned a few minutes ago, the S&P 500 equally weighted is the exact same payoff as Swiss equities. So this means that if the market is half right on the direction of interest rates and the Fed delivers what it guides for, absent an inflation surprise of a nasty kind, not our scenario for 24, this means we should have a much more balanced relative performance between the S&P 500 cap-weighted and its equally weighted iteration, and therefore Europe and Switzerland in particular, that was our question from the audience earlier, should perform much better in line with the S&P 500.
Okay, thank you. What are the risks of the high level of government debt in Europe and the US on their economy? What is the maximum it can reach in the next decade before creating deep economic crisis?
Well, one of the reasons why we have observed and witnessed the stunning rise of interest rates of the last year and a half, with combination of disbelief and concern, is because today, out there are 80 trillion worth of debt to refinance. So if you assign a 5-year average maturity to government, corporate, and household debt in the world, this means that, give or take, you have 15, 20 trillion every year of debt to be refinanced. The more debt there is out there, the least expensive interest rates refinancing costs can a debtor afford. Otherwise, you're going to have a cascade of disorderly debt defaults, highly deflationary. So that gigantic stock of debt in the system exert a pressure on the ability of interest rates to go up. Only exception of that is if central banks suddenly were shifting towards inflationary policies, and therefore the rise of nominal GDP would make such levels of debt in nominal terms affordable again. That's not the scenario. We think 3% is the new 2% as far as inflation is concerned, due to the changing dynamics in the labor market, in particular the retirement of the baby boomers cohort that has started, shifting the supply and demand equation for labor in the Western world. This will be mitigated by some technological progress. We see that in our everyday lives experience, but there is clearly something that has changed in the equation for supply and demand of labor. And in that 3% world, it's Goldilocks for equities. We think the relative valuation of bonds and equities are normalized. So, big picture. In 2000, we had a big equity bubble, and bonds were attractive. In 2020, we had a gigantic, on purpose, created by policymaker bond bubble, and that bond bubble has bursted. Things have now normalized. the relative valuation of stocks and bonds is pretty fair today. You see that in the US, 10-year treasury just fell yesterday below 4. It's around 4. The free cash flow yield of the S&P 500 is 4% as well. It's an equally attractive bet. If you bet on 3% inflation rather than 2 on average in coming years, equities keep an edge on the nominal claims on bonds.
Okay, so you say that the 3% is the new 2%, but do you think we'll see 2% inflation within the next decade?
We might see zero temporarily. Yeah, no, I mean, we might. Look, as a result of what the central banks have done and the massive tightening of the last few months, we have M2 year on year in negative territory in America. A lot depends also on some key input prices. Of course, oil comes first. We could temporarily undershoot, but we think the new average is closer to 3 than 2% probably. And one of the reasons is the amazing amount of debt that needs to be refinanced.
Mm-hmm. A question here on digital assets and the world economy. Do you think that digital assets could become global currencies in the next decade?
No, we've never believed this. The privilege and the monopoly of printing money is not something that any government would even consider for half a second giving away. That's not happening. Digital assets have other potential business applications, still to be seen. And there's one that will keep an iconic role in all of this, which is Bitcoin, obviously. And we've said time and again, we're not very keen on gold. I mean, if you look at gold on a rational basis, it's an asset with an extremely poor risk and reward profile. It's equity risk with sometimes less than cash returns. If you want to have it as a diversifier, because it does have limited diversification benefit.
But this is what everyone uses gold for, no?
Bitcoin is a much better alternative.
Okay.
Bitcoin is gold in digital form. So if you want to have 3% of gold, buy 1% of Bitcoin, and you're covered.
Okay, we're getting into recommendations here, so I'm going to end it. But Yves, it's always a pleasure to hear you speak. Thank you so much for all your inputs. If you would like more, you can actually download the Secular Outlook digital brochure, where Yves and his team go into much more detail on all of the topics that we've discussed today, plus many, many more. And don't forget, of course, as you all asked some kind of more short to medium term questions today, we'll be getting into the details of what to expect in the next year as we launch the Market Outlook on January the 18th. I'll be joined by Marco Papic from Clock Tower and Christian Gattaker, Julius Baer's Head of Research. And we also welcome your participation and questions as well. And don't forget, we'll also be offering that in German as well. Until then, don't forget to stay up to date with the latest investment insights by checking out the Beyond Markets podcast. It's updated a couple of times each week, so you can subscribe for the latest editions. There are the QR codes on your screen now. Meanwhile, Moving Markets is our daily podcast that puts the ups and downs of the market into perspective, both, of course, available wherever you get your podcasts. Thank you for joining us today. We'll see you on January the 18th next year. Bye-bye.